5 specific classes of wealth endured the total disintegration of economies, while other fortunes vanished completely. In the year 1946, the citizens of Hungary witnessed the most extreme monetary death in recorded history. At the peak of this madness, prices across the nation doubled every 15 hours. This was not a gradual decline. It was a vertical drop into an abyss. Just a short time prior, the currency was a medium of exchange. Suddenly, it was literal trash clogging the gutters. People stopped counting bills and started weighing them by the kilogram just to buy basic supplies. They used high-denomination notes to patch holes in their shoes or as kindling for kitchen fires because the paper had more utility as fuel than as money. The legal tender hit zero. However, 5 distinct categories of assets did not merely persist. They functioned as the bedrock for the next generation of wealth. The individuals who recognized which items retained their essence during a systemic fracture did more than just survive the storm. They were the ones positioned to acquire entire industries when the smoke finally cleared. This is not some dusty academic theory from the past. This is a recurring structural phenomenon that manifests whenever a debt-laden empire reaches its breaking point. We saw it in the Weimar Republic in 1923, in Yugoslavia in 1994, in Zimbabwe in 2008, and in the tragic decline of Venezuela in 2016. Argentina has experienced this cycle nearly half a dozen times in a single century. Every single breakdown adheres to a predictable timeline. It begins with the dilution of the currency, moves into runaway inflation, transitions to a complete freeze of the markets, and ends with a brutal asset reset. Certain holdings are deleted from existence, while others become the only things that matter. The gap between total insolvency and generational preservation is defined by your ability to distinguish between the two before the gates close. The current economic red line. As we navigate through 2026, we are witnessing the opening chapters of this script being written once again. The national debt of the United States has surged past the $39 trillion mark. The rate of monetary expansion has outpaced almost every historical precedent except for the height of the 2020 global crisis. Since the start of this decade, the actual purchasing power of the dollar has eroded by more than 22%. Every critical warning light that signaled the end for the Soviet Union or the collapse of the Roman denarius is currently screaming in red. We are no longer debating whether a correction is possible. We are now calculating the exact moment of the impact and its ultimate velocity. 5 specific assets will safeguard your labor while the rest of the financial world turns to vapor. Let's dive right in and take a look at the 5 vehicles that have successfully navigated every significant economic ruin in the modern era. We will also break down the zero-bound assets and uncover why grasping this divergence today is likely the most consequential financial choice of your life. The historical record is remarkably consistent on this point. Time has conducted this experiment 100 times over, and the conclusion never deviates. But before we jump into naming those 5 survivors, let's explore the actual plumbing of a collapse, rather than the sterilized version you might find in textbooks. You need to see the raw mechanics of how value is siphoned away and where that energy eventually settles. The mechanics of the spiral. A systemic failure always originates with the debasement of the medium of exchange. The state begins printing new units of currency to satisfy obligations it can no longer cover through productivity or taxation. In the beginning, this theft is nearly imperceptible to the average citizen. You see prices creep up slowly. Inflation at 4% or 6% feels like a minor annoyance, but the momentum is cumulative. Growing debts demand even more printing to service the interest. Increased printing triggers higher prices. Higher prices require a larger volume of money just to keep the gears of the economy turning. It is a self-reinforcing vortex. Then the vertical phase takes hold. This is the stage where the middle class is systematically liquidated because they lack the speed to react. Inflation leaps from 8% to 20% in a single season, then jumps to 50%, then 500%. At this point, percentages lose their meaning entirely. We start measuring the destruction in hours. In the final days of the Weimar crisis, the cost of goods doubled every 37 days. In the Zimbabwean tragedy, prices doubled every 24/7 hours. In the Hungarian catastrophe of 1946, the doubling occurred every 15 hours. Imagine the reality of that situation. You wake up and a gallon of milk is $8. By the time your shift ends, that same gallon is $16. By the following morning, it is $32. By the next sunset, it is $64. Your salary, your hard-earned savings, and your retirement fund all become meaningless because the currency is expiring faster than you can trade it for physical goods. This is the face of a true collapse. During this panic, people commit the same fatal errors every time. They cling to cash, hoping the market will return to normal. They leave their capital in banks, assuming the institution is a fortress. They buy government debt, believing the state will honor its word. They are holding paper, and history proves that paper always returns to its intrinsic value of zero. The assets that evaporate, the road to zero. Let us analyze exactly what gets wiped out in every major historical reset. The first casualty is always the most obvious, the cash itself. The very thing that most people define as money is the first thing to hit zero. In the era preceding World War I, the German mark was a premier global reserve asset. It was backed by the immense industrial output of the most powerful economy in Europe. By late 1923, it required 2 trillion marks to obtain a single American dollar. The currency did not just lose its luster. It lost 999% of its functional reality. If you had saved 1,000,000 marks in 1918, by 1923, you couldn't trade that fortune for a single loaf of bread. It was a total deletion of wealth. The story was identical in Zimbabwe. In 1980, their dollar was actually stronger than the US dollar. By 2008, they were issuing $100 trillion bills that couldn't even pay for a bus ride. The currency died completely. The nation eventually surrendered and started using foreign bills because their own paper was literally not worth the ink used to print it. In Venezuela, the bolivar has surrendered over 99% of its value in the last decade. A currency that was once stable is now a mathematical joke that continues to plummet every hour. Cash is the primary victim because cash is the tool the government uses to monetize its own failure. The second category to fail is government bonds. In a stable world, these are considered the risk-free benchmark. In a collapse, they are the most toxic asset you can own. A bond is simply a promise that a government will return your capital with a small premium later. But when that government is manufacturing infinite money to stay afloat, those promises are lies. If you held German sovereign debt in 1918, you were seen as a prudent and conservative saver. By 1923, your investment was worth nothing. The state repaid you in full, but they paid you in marks that had no purchasing power. You received 100% of the numerical value and 0% of the actual wealth. You were effectively robbed by the very system you trusted. The Soviet Union followed this exact script. Citizens held state bonds for decades. When the USSR dissolved, those bonds were essentially canceled. There was no entity left to pay them and no viable currency to pay them in. It was a total loss for the populace. Argentina has defaulted on its debt 9 times in its history. If you were a bondholder during those events, you were forced to accept haircuts of 70% or more. Often, the recovery was zero. A bond is only as reliable as the government's ability to tax a productive economy. When the economy stops, the bonds die. Next, we must look at stocks in non-essential industries. This is a nuanced point, but it is vital for survival. During a systemic break, most traditional businesses simply cease to function. Luxury retail, high-end travel, entertainment, and non-essential consumer goods are the first to be abandoned. During the Great Depression, the vast majority of equities lost 90% of their market capitalization. Iconic companies that defined the 1920s were bankrupt by 1935. But the market as a whole didn't disappear, only the fluff did. If you owned shares in the Radio Corporation of America in 1929, you watched 97% of your wealth vanish. If you held New York Central Railroad, you lost 98%. These were the blue chips of their day, and they were essentially wiped out. However, companies that provided electricity, basic food staples, or medicine managed to endure. Some even prospered. The logic is brutal. When the world is ending, people stop buying jewelry and start buying calories. Businesses that do not provide life-sustaining value will go to zero. The fourth zero is real estate in stagnant zones. Most people believe that land is the ultimate safe asset, but location is a multiplier that can turn to zero just as easily as a currency. In the city of Detroit, homes that were valued at $100,000 in the year 2000 were being sold for $1,000 by 2010. That is a 99% destruction of value. In Spain and Greece during their respective crises, property values cratered by 60% and stayed there for a generation. Why? Because the value of a building is inextricably linked to the economic activity around it. If the local factories close, if the shops are boarded up, and if the productive people flee, your hard asset becomes a liability. You might hold the deed to a structure, but if there is no buyer and no economy to support it, the value is zero. Finally, we have paper wealth. This includes bank balances, digital pension funds, and 401k accounts. These are all just digital entries representing a promise to pay you in a specific currency at a later date. In Cyprus in 2013, the government simply confiscated 47% of bank deposits over 100,000 euros to save the banking system. People woke up and found half their life savings had been stolen by decree. In Greece, the banks were locked, and citizens were limited to withdrawing 60 euros a day. Your money was trapped in a burning building while inflation ate the walls. In Detroit, retired city workers saw their pensions slashed to pennies on the dollar after the bankruptcy. These people had worked for 30 years for a promise that evaporated in a courtroom. Paper assets and currency, denominated promises always fail when the system that underwrites them breaks. The 5 survivors, the bedrock of wealth. Asset 1. Physical gold. This is the definitive hedge against the death of a system. Gold is not valuable because of a magical spell. It is valuable because it has been recognized as the apex of money for 5,000 years of human history. When every paper experiment fails, gold remains standing. In the Weimar Republic, if you had traded your marks for gold coins in 1918, you didn't just survive, you became incredibly wealthy. While your neighbors were using stacks of cash to start fires, you could buy an entire apartment block for a handful of gold ounces. The transfer of wealth was historic. The gold holders became the new elite, while the savers became the new poor. In Zimbabwe and Venezuela, gold became the shadow currency that allowed people to eat. The official economy used the worthless paper, but the real economy of food and fuel ran on gold and foreign hard currency. Gold cannot be manufactured by a central bank. It cannot be debased by a politician. It is finite, and in a world of infinite printing, scarcity is the only thing that holds value. Asset 2. Physical silver. If gold is the foundation of wealth preservation, silver is the engine of daily survival. It shares all the properties of gold. It is scarce, durable, and globally recognized. But its lower price point makes it the perfect medium for small transactions. During the German collapse, people used silver coins for their weekly groceries. A gold coin was too valuable to use for a loaf of bread, but a silver coin was the perfect denomination. In modern Venezuela, pre-1965 U.S. silver quarters are being used as a primary medium of exchange in rural areas. A single silver coin can often buy a week's worth of supplies, whereas the local currency cannot buy a single egg. The historical ratio between silver and gold is typically 15 to 1. Today, that ratio is stretched to nearly 80 to 1. This means silver is significantly undervalued and offers even more upside when the monetary system resets. You must hold the physical metal, however. A certificate or an ETF is just another paper promise, and promises fail during a collapse. Asset 3. Productive agricultural land. Do not confuse this with general real estate. I am talking specifically about land that can grow food and provide water. This is one of the few assets that actually gains utility when a currency dies. People can skip a movie or a new car, but they cannot skip dinner. In the wake of the Soviet Union's fall, the people who owned small garden plots, or dachas, were the ones who didn't go hungry. They grew their own calories and traded their surplus for everything else they needed. That soil saved their lives. In Venezuela today, a farmer with a few acres is in a far better position than a doctor in the city. The farmer has the ultimate currency, food. The doctor has a pile of paper and an empty stomach. The land must be arable, it must have a water source, and it must be within reach of where you live. Land in a remote desert is useless. Land that produces a harvest is a fortress. Asset 4. Essential commodities. These are the items that keep a civilization running: fuel, medicine, storable food, and energy. Demand for these items never hits zero. During the hyperinflation of the 1920s, farmers who held grain and livestock became the new kings of the economy. They could demand payment in gold or hard assets because they held the lifeblood of the people. In a collapse, a can of meat or a bag of salt becomes a high-velocity currency. During the siege of Sarajevo, a bottle of simple antibiotics was worth more than a diamond ring because the medicine could save a life, and the diamond could not. Energy is equally critical. If you have a stockpile of diesel or propane, you have the power to move, to stay warm, and to generate electricity. In the Russian collapse, gasoline was the ultimate black market currency. It had immediate utility, and in a crisis, utility is the only true measure of value. Asset 5. Productive skills and tools. This is the asset that no government can seize and no inflation can dilute. Your ability to solve physical problems is the most portable and durable form of wealth in existence. When the complex financial systems of the Weimar Republic broke, the lawyers and bankers found themselves in bread lines. But the carpenters, the plumbers, the mechanics, and the tailors were still working. Their skills were needed to keep the basic world functioning. They could trade their labor directly for eggs, milk, and gold. In the modern world, we have become a knowledge economy. But when the power goes out and the banks close, knowledge of marketing is worthless. Knowledge of how to repair a tractor or heal a wound is priceless. You also need the tools of your trade. A set of high-quality hand tools is a wealth-generating machine that never loses its value. The three-legged stool of survival. True survival does not come from picking just one of these assets. It comes from a balanced allocation. You need the monetary leg, gold and silver, to protect your purchasing power. You need the physical leg, land and commodities, to ensure your basic needs are met. And you need the intellectual leg, skills and tools, to generate new value every day. Historically, the families who emerged from a collapse with their wealth intact relied on a rough, practical balance, keeping a healthy chunk of their portfolio in precious metals, a similar portion in productive land, and a solid baseline in essential goods and tools. They intentionally kept only a tiny, functional fraction of their wealth tied up in the dying currency. This allowed them to stay liquid, stay fed, and stay productive. When the reset was over, they used their preserved gold to buy up businesses and property from those who had stayed in paper and lost everything. The timing of this shift is the most critical element. You cannot wait for the headlines to tell you the collapse has arrived. By the time it is official, the cost of protection will have already mooned. The people who converted their marks in 1919 saved their lives. The people who waited until 1923 were wiped out. Right now, in 2026, the window is still open. Gold is still tradable. Land is still available. Skills can still be mastered. But the smart money is already moving. Central banks are currently hoarding gold at the highest rate since the 1960s. The world's wealthiest families are shifting out of the stock market and into vast tracts of farmland. They are telling you to stay the course because they need someone to buy the assets they are quietly exiting. History does not lie, and the math of $39 trillion in debt cannot be ignored. You can trust the system that is currently printing itself into oblivion, or you can trust the five assets that have never failed. The choice you make today will determine which side of the wealth transfer you are on when the pattern completes itself. If you want to understand how to build a portfolio that survives a reset, then stay focused on the fundamentals. The assets that survive don't change because human nature doesn't change. Which side of history will you be on?